Hey, y'all. Welcome to the Winning at Life podcast. I've been doing live radio for over 16 years, and I almost want to say, welcome to the Winning at Life radio show. I've done it for so long now. But the new thing is podcasts, and that's what we're into as well. And guess what we're into today? A deeper dive into Trump accounts. Recently, I covered part one of Trump accounts. This is kind of the continuation of that previous one. We just didn't have time to get all the content out. So this is really some good stuff today, and I'm going to talk about some of the compounding of that money as well, which is, that's always been one of my fascinations ever since I was a kid. Taking things apart and compounding money. So that was the kid in me, and that's still the grown up in me. So shout out to our show sponsors, J. Heath and Company CPAs, MortgageGumbo.com with Dwayne Stein, W.J. Blanchard Law, NewOrleans.MosquitoJoe.com, JJS Audio and Video. Reach out to Jeff over there. Pat Huber, FirstSouthland.com. They're with First South Farm Credit. You might have caught their recent podcast where we talked to Pat Huber about land acquisition. See, who's next up there? Oh, can't forget iHeartMedia. Heck, that radio show wouldn't have started without them coercing me, coaxing me, or talking me into doing live radio a long time ago. It was crazy. Yeah, they said, yeah, and we want you to take live calls. I'm like, what? Why would I want to do that? Turns out every time, we sit down with clients and have meetings, what are the people going to do in the meetings? Ask questions. So once I wrapped my mind around that, I was, well, heck, I answer questions all the time. So it was easy. Podcast's easier. I'm not taking calls, but you can sure write in questions, and you can surely write in topics. info@gregoryricks.com. If you've got some concerns you'd like answered, what's your greatest concerns for retirement? Give us some feedback and some topics you'd like to hear on the Winning at Life podcast. I know it's not on my list of things to say, but it just popped into my head. Because at events we do or have done in the past, we've always done a survey. What's your primary concern? Share it with us, and we'll address it here on the podcast as well. Let's see, where am I at? iHeartMedia. Oh, and also Gregory Ricks Total Wealth. Be sure to subscribe to the Gregory Ricks Total Wealth YouTube channel for on-demand financial content. New Winning at Life podcast episodes are posted every Wednesday at 3 p.m. It's like clockwork, 3 p.m. every week. Also, like, comment, subscribe, and hit the bell notification to be alerted whenever we release new content. And Chris, that heads up my podcast team, he's always talking to me about ideas and stuff to get more content out of there, and working. I think we're going to spend some time working on some shorts, and you can help us out with some ideas. So once again, the focus of today is continuation, a deeper dive into Trump accounts. I want to kind of go over the executive summary and this content. I'm kind of referring to is from Ed Slott's IRA Advisor, and I've got another article I'm going to reference here in a few minutes regarding some of the content. But in this executive summary, I covered it in the first episode of this, but I'm going to run through it again and a couple other thoughts. There have been a number of developments relating to Trump accounts since our last article was published in September. And here are a few of the highlights. If the 5,000 annual contribution limit is exceeded, the excess contributions plus attributable earnings must be withdrawn. One of the concerns is families contributing. Oh, I want to contribute to Jimmy's account. The grandmother want to contribute to it. The grandpa on the mom's side wants to contribute to it. It isn't going to quite work like that. So that account cannot have more than $5,000 contributed to it, to be clear. Before a Trump account contribution can be made, a formal election to open an account must be made by completing IRS Form 4547 and submitting it by hard copy, electronic filing, or through the trumpaccounts.gov website. A separate election also through Form 4547 is required for someone claiming the $1,000 federal government contribution. If an election to open an account is not made along with the $1,000 election, the person authorized to establish the Trump account must be the child's legal guardian, parent, adult sibling, or grandparent. And it's in the order of priority. The most significant special Trump account rule applies until the child's age 18 year is that Trump account dollars generally cannot be withdrawn. They don't talk about their age 18. It's the year in which they turn age 18. And for federal tax purposes, 3 types of contributions: the federal government contribution, the employer contribution, and contributions by tax-exempt organizations have no basis and are fully taxable in the year they are withdrawn. On the other hand, contributions by parents or grandparents or others must be after tax and are therefore basis in the account. Here's on the last episode, one of the last areas I kind of talked about, and I'm going to retrace right there since we kind of talked about basis. For the federal tax purposes, 3 types of contributions: federal government contribution, employer contribution, and contributions by tax-exempt organizations have no basis and are fully taxable in the year they are withdrawn. On the other hand, contributions by parents or grandparents or others must be after tax and are therefore basis. Distributions of those contributions themselves are tax-free, but earnings are subject to tax and possibly a 10% early distribution penalty. The pro rata rule, you have to love that rule. The pro rata rule allows, I used the wrong word there, allocates basis when someone with both pre-tax and after-tax IRA funds receives a distribution. Applies to Trump accounts. However, when applying the rule, all other IRA funds are disregarded. So a portion of the most Trump account distributions will be taxable and possibly penalized if distributed before age 59 and a half. Most states will tax Trump accounts the same way they are taxed for federal taxes. However, at least 7 states, California, Hawaii, Kentucky, Massachusetts, Pennsylvania, South Carolina, and Wisconsin have announced they will not recognize Trump accounts as IRAs, but will instead tax earnings annually. Others may follow. Residents of those non-conforming states will face having taxes on Trump accounts calculated one way for federal taxes and another way for state taxes. New topic for this podcast: Trump accounts versus 529 and UTMA and UGMA accounts. If a child qualifies for a $1,000 federal government contribution or contributions made by an employer or charity, there is no financial reason why a Trump account should not be open to at least receive this free money. Whether a parent should make an individual Trump account contributions is a more difficult question. Funding a Trump account as opposed to a 529 plan or UTMA or UGMA custodial account may make sense if the account is intended as a long-term retirement savings vehicle, especially if it will be converted to a Roth IRA. If the goal is to save for the child's education, then a 529 plan offering tax-free growth and higher contribution limits could be a wiser choice. I was going to say contribution choice, kind of same thing. Be a wiser choice than a Trump account. Finally, the funds are not likely to be retained for retirement, and UTMA or UGMA account may be better than a Trump account because these accounts are more flexible, higher contribution limits, and no pre-age 18 withdrawal or investment restrictions. However, earnings on UTMA and UGMA accounts are taxed annually. I know that is really a deep dive, and I'm going to touch on that here another way here in just a few minutes. But one thing I wanted to share is how awesome this concept is from a money standpoint. I'm just throwing out there, and that's where some family members may want to fund these Trump accounts, but some other grandparents and all want to get involved and help the kids and build up money. Well, there's 529 plans. There's UTMA and UGMA accounts as well that you can help fund and put money into. And as a family, if there's a number of people wanting to contribute, we can do something special for the children in your families out there. But one of the things, I just wanted to look at the math here real quick. If we're getting $1,000 from the government, and then parents are putting in $5,000 a year, and we're going to do it to age 18 as an example, just to see what does this look like for them when they reach age 18. And we're going to make the math simple because I like compounding money. Rule of 72, using 7.2%, money doubles every 10 years, makes it easy. Initial investment, $1,000, $5,000 additional every year. Frequency we're going to be putting in is yearly. At the end of 18 years, in that account, we'll hold $189,269.69. It is subject to putting that $5,000 a year in. It's subject to 7.2%. Could well be less than that because less yield. I'm just using this as an example. But if this was kind of, say, a retirement account, and then the taxes are paid on it when they reach age 18, and it's left to contribute or converted to a Roth style account, because really what is a Trump account? I'll tell you fundamentally, I already kind of covered that. It is a retirement account. So what if we did 50 years instead? Give me a guess. What do you think? What do you think could be in it? 500,000? Million? $1,500,000? $1,700,000? Less? More? Well, here's the number. $2,365,424 and some change. It's $5,000 a year for 18 years. and they keep putting in $5,000 a year thereafter. It's not a big ask. Think about that. $5,000 a year, every year to age 50. In today's dollars, they're set pretty well. Something to think about. You know, you can get a calculator and just say, well, what if nothing else was put in thereafter? So we could run this thing a number of ways, but if we're doing that every year, and even there might be some UGMA 529s thrown their way as well, but $5,000 a year, if somebody's capable of doing that and teaches them along the way and the habit and to keep doing that, yeah, at age 50 they got $2.3 million. Here's an article from Investment News by Greg Greenberg. So it's basically talking about the Trump accounts, and it coincided with the 250th anniversary. And also, Secretary Bessent said the other day there's now over 7 million children have enrolled in Trump accounts at this time. So this is an article kind of talking about advisors looking at like how do you guide people on this. So I kind of have three topics here. And once again, for more than 7 million enrolled as of here late July, according to U.S. Treasury, with more than 1.5 million eligible for the government's $1,000 deposit. Advisors navigating the questions, three practitioners offer a framework for these accounts and where they do not. 3 accounts, 3 jobs, match them to the goal. Matt Waters, over at Prime Capital, puts 3 types of accounts in the category by intent, but different categories by function. A 529 plan is the cleaner choice for education. Most states offer an income deduction. Most states offer an income deduction on contributions, with withdrawals for qualified education expenses come out entirely tax-free. A Trump benefit accounts do not replicate. A custodial Roth account is the most powerful vehicle for long-term tax-free growth, but it requires earned income, making it inaccessible for most children below working age. A Trump account fills the gap for early retirement style savings without an earned income requirement, but it trades the Roth tax-free withdrawal treatment for a traditional IRA rules, ordinary income tax, and a 10% early withdrawal penalty before age 59 and a half. The Trump accounts shine for kids between January 1 of 2025 and December 31 of 2028, where the federal government will deposit seed $1,000 into the eligible child's account. It's not a case where one is always better than the other. The answer, like so much in financial planning, depends on where you're trying to go and what you're trying to do. Waters frames the contribution decision in terms of household sequencing. Before funding a Trump account, he wants to confirm the parents are on track with their funding their own retirement. After that, allocation depends on whether the family's primary goal is funding education, providing a retirement head start, or building a longer-term financial cushion for adult children who may need support. None of those goals is answered by a single account type. James Comblow, certified financial planner at Prosperity Capital, basically says the tax trap most families won't see coming. He leads with a clarification that clients consistently miss. A Trump account is a retirement-style Trump account for a child, not a college savings vehicle. 2 problems require 2 different tools, and conflating them is the first mistake. The second mistake, and the one Colombo is most concerned about, is misunderstanding how the tax treatment works in practice. Only after tax contributions made by family members creates basis in the account, meaning that portion is not taxed again on withdrawal. The 1,000 federal seed contribution, employer contributions, charitable gifts, and all investment growth are taxable upon withdrawal. The implication is that a family contributes 4,000, receives 1,000 government deposit, and watches the account grow to 40,000, should not assume the full 40,000 exits the account tax free. Our next one is Patrick Marcinko, advisor at Bogart Wealth. His contribution is the account is a container. It's what inside it is what matters. He identifies one structural advantage that genuinely distinguishes Trump accounts from every other retirement vehicle: the absence of earned income requirement. A custodial Roth IRA is powerful, but it cannot be funded for a newborn or a child without wages. A Trump account can, for families with discretionary cash flow who want to give a child a multi-decade runway in tax advantage structure. That feature is meaningful, but the account should be evaluated alongside 529s and custodial Roths based on family-specific goals, not open reflexively because it is new. I know I threw a lot at you. If you got questions, we're going to be talking more about these here in the near future. And maybe one day we have a deeper dive in the Trump accounts. But this was a lot here. And if you have questions, you can reach our office, 504-832-9200. Email me, info@gregoryricks.com. Go to the website, gregoryricks.com, for more information. And you need to visit the website for more of our upcoming events and educational events. And once again, we offer in-person virtual meetings. We offer in-person meetings and virtual meetings. We can do a combination of the two as well, which it sounded like is what I was describing there. We'll do both, either or. Be sure to subscribe to our YouTube channel as well as for more financial content. As always, I appreciate you listening. And remember, new shows every Wednesday at 3 o'clock. And thanks for listening to Winning at Life podcast. Keep winning.